What exactly is a stock? That's what we're going to be talking about today in this session, so let's move forward. Welcome to the Plan Ranger, where our goal is to provide you with informed insights and a reasonable approach of managing your personal finances. So yesterday, if you saw our video, the first one we've done was basically referring to the question of how do you get started investing in stocks? And of course, that video spurred another question, which was exactly what is a stock? And that is one of those things that people tend to have a general sense about, a general kind of idea of, yet they couldn't really tell you exactly what it is or have a fundamental understanding of actually what a stock is in the first place. And so we thought we'd do this video just to kind of explore that a little bit. And I think one of the best ways to talk about what a stock is to probably provide a kind of simple example. Let's say, for example, that you have a friend and this friend wants to start a business. She wants to open up a coffee truck company, right? Or open up a coffee truck. So she comes to you and says, can you help me out? Can you give me some money or capital? There are two ways that you could essentially help her out. You could lend her some money or you could buy into the company. Let's talk about the first one, lending first, just to be clear. So you could basically tell her, hey, you know what? I'm going to give you some money and we're going to set up a repayment schedule and you're going to pay me some interest along the way too. So maybe you're going to pay me 10% a year over the next 10 years. And then you're going to owe me the amount that I lent you in the first place as well. As part of that deal, you could also say, hey, and just so you know, I'm lending you this money, but if your business fails, we're going to use the coffee truck as collateral or maybe even some personal assets. But generally in this instance, let's just talk about using the truck as collateral so that if you go out of business, I basically have a claim against that truck to recoup my investment. And so there could be some collateral structured in there as well. The other way you could go would be to give her some money, basically buy into the company and become a stakeholder. In this instance, you're becoming a stockholder or shareholder. You're becoming an owner of the company with her. In doing this, you're taking more risk, but you're also getting more reward. Well, why is it more risk? First and foremost, when you become a stockholder, if the company goes bankrupt, you have no claim against the assets, really. I mean, eventually you could get paid, but you're kind of last in line without getting too deep into the weeds on this. And so you're taking a pretty immense amount of risk that you could lose your entire investment. But there's also the upside, the reward side of things, which is that if the company does well, if your friend is great at business, you're not only going to participate in profits, but you are also going to see an increase in your share value too. So what that basically means is, let's take, for example, some profits here. At the end of the year, if she did very, very well and had leftover money, she could take that money and either pay it to you in the form of a dividend, right? Or she could take the money and reinvest it back in the company and help, maybe buy more coffee trucks or something else that causes the business to grow and do more and be worth more in the future, hence increasing your share value. To put kind of some figures on this, let's take an example. Let's say that you go to her, or she comes to you and you give her $25,000. You say, hey, you know what? It's going to cost you 50 grand to start up. I'm going to give you 25,000, but for that, I get 50% of the company. Okay. Let's say that over time, let's say 3 years from now, she's been doing great. And by the end of the third year, she's bringing in $40,000 of profit. That's after all the expenses and everything else is paid out. There's $40,000 left over from the year in terms of profit. There would be a couple choices there. She could take that $40,000 and basically pay you half of it, $20,000 for your 50% stake. You get a $20,000 dividend. Or that money could be rolled back into the company, buy more trucks, do more business, and grow. So not only could you be sitting there getting the profit there, that $20,000 of a dividend, but in addition to that, your shares grew too. A company that's doing that, let's say $40,000 in profit, could be valued anywhere from $125,000 all the way up to $250,000 maybe, if they were trying to sell the business. Those are kind of loose examples, but wouldn't be out of the realm of possibility for a business like that, especially one growing like that, to be valued in that realm. So now your shares, your 50%, your $25,000 investment could now be worth something like 60,000, 100,000, 125,000. So you've seen really good growth. And just so you know, most people for a 3-year time frame would consider that a pretty good rate of return. So that's, you know, that's kind of what you're looking at here. You could become a stockholder, you can become a lender. One other key difference with being a stockholder is because you're an owner of the company, you should get a say in how that business operates. So, you know, even if you buy shares in a large company like Apple, Amazon, United Airlines, you know, General Motors, whatever, if you own a share of that company, you, in theory, get a say in how that company can operate. That's usually why they hold annual shareholder meetings, things like that, or they'll ask, you know, shareholders to vote or for their proxy or something like that. It's because you, as an owner, get a say in the company. And keep in mind, everything that we're talking about here, you investing in your friend's business, you know, sure, it's a little, you know, we're talking about a small operation, hopefully so that it makes a little more sense. That, okay, I understand my friend, she needs money. I can either lend it to her and become you know, she can go the debt route. That'd be kind of like a bond, or I could buy into the company with her and participate in the risks and rewards of how that business goes. So those are kind of the two ways there. The same concept applies to big companies like Apple, like Amazon, like Tesla, you know, all large companies. When they need capital, when they need money, they'll go one of those two ways. They'll go either out to the debt market and they'll issue bonds, or they'll do something like sell part of their company and issue shares of stock that anybody can buy. So those are the two ways, whether big or small, that's kind of how that works. Now, if you're looking at using stocks in your portfolio, one of the things you need to keep in mind is the example with the friend here. What we're talking about there is a private securities transaction. In other words, her coffee truck enterprise isn't listed on the on the NASDAQ. It's not a publicly traded stock. There's no secondary market where it can be bought or sold, really. When most people are talking about stocks, and on this channel, when we talk about stocks, what we're referring to is publicly traded companies. So a lot like the names I've already mentioned so far, those types of companies would be the things that you can buy and sell kind of at will. There's a lot of liquidity to them. There's secondary markets, meaning once the stock's been issued to the original holders, then that person can sell it to somebody else, and so on and so forth. There's generally a market to buy and sell these things, all the time, and with ease. So what we're talking about is publicly traded stocks versus private. But all the things that come into mind that we mentioned for your friend, for the coffee truck enterprise, all those same things apply when you buy shares of a large company. You get to participate in their dividends. You get to participate in their profits. You can, participate in the buybacks and the stock splits, in the growth of the company, in the increase and decrease of share value. All of those things pertain to you as an owner of that company, even if you only own one share. And keep in mind, when you buy companies like Amazon and Apple and all that stuff, you could take your $25,000 that you were going to give your friend and go buy those companies. Just keep in mind, you're really not going to have much of a say in the company. When you look at what they're worth, your friend's coffee truck company had an initial value of $50,000, and all these other companies are in the billions. So your $25,000 isn't going to get you quite as much power in the room, let's just say, but it's still there. That's all we have for today. So hopefully this was short and sweet for you and to the point. If you have any questions or feel like we missed anything, go ahead and leave them in the comments down below, or go ahead and click the subscribe button to stay abreast of the new videos that we're putting out pretty much every day here. Thanks for taking the time. We hope this helped.